Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the market for the remainder of 2019 and beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their own financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by JP Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I'll point out the information I think is most relevant. The opinions expressed are mine and not necessarily those of Raymond James, and JP Morgan is not affiliated with Raymond James. This quarter, there are four main themes I want to discuss, and the first of those is talk about our recession risks. They are rising. First quarter GDP growth was greater than 3% annualized over the same period of the prior year. However, the risk of recession is growing. Interestingly, the recession risk isn't from the usual channels. Consumer spending actually is very strong. The slowdown is anticipated in the investment and inventory areas of the economy. These areas are largely affected by uncertainty, and the cloud hanging over international trade, largely due to tariff talks, may be a major factor here. Businesses may have front-loaded their inventory needs to get ahead of import tariffs. Both areas are strongly mean reverting. This means that higher than average numbers in prior quarters may be met with lower numbers in subsequent quarters. The strength we have seen over the last year is the main reason economists are forecasting a drag on GDP for the remainder of this year. Total year-over-year growth of GDP is expected to be around 2%, a little bit higher than that. And if we see 1% GDP growth this quarter and next, as anticipated, we should hit that number. Inflation remains subdued, and one reason is that below-average wage growth continues. Even with historically low unemployment, employers still have pricing power in this economy. Another reason for subdued inflation in this environment is the expectation for a slowly softening dollar and a closing interest rate gap between other developed markets and the U.S. The price of oil can be a significant drag on our economy when it rises significantly. Recently, OPEC and Russia agreed to not increase oil output to keep up with global demand. As you can see in the upper left chart, they have lost some of their influence when trying to increase the price of oil. American production has been largely responsible for global production keeping pace with consumption. A price of oil above $50 a barrel allows American shale oil producers to produce oil for a profit, not so much below $50 a barrel. American producers are helping to keep the price of oil in check globally. Because of a combination of these factors, inflation is expected to remain tame for the time being. Let's talk about what's expected for interest rates. The recent movement in interest rates has actually been downward. Currently, investors in the 10-year Treasury are realizing a real yield of 0 relative to inflation. At these levels, fixed income is better used in a portfolio as a hedge against equity volatility than as an actual income vehicle. Stretching for yield can prove to be problematic for investors. The greater the yield in this environment, the greater correlation to equities. In other words, those who invest in bonds as a hedge to equity volatility may experience equity-level volatility in their bonds by reaching for too much yield in this environment. The current expectation is for a rate cut by the Fed at the end of this month. The disconnect in this chart may be explained by the survey of Fed governors. There are 17 members who forecast interest rates. Among these, the average is for rates to possibly ease but return quickly to current levels. However, of the 17, only 10 actually vote on rates. Among those who actually vote, there is greater dovishness, with an average anticipated rate cut of about 50 basis points by the end of this year. They will make their next decision at the end of this month after they've been able to digest the recent employment report and the second quarter GDP numbers. Let's talk about the equity markets. Between March 9, 2009 and the end of June 2019, the S&P 500 increased by 335%, excluding dividends. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that we have been through what's known as a secular bear market. There are really two phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 16.7 times, and now it's up from 16.4 last quarter. The yield on the S&P 500 is still competitive with 10-year treasuries. This chart shows secular bears and secular bulls. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time's can answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. Equity valuations depend on both the price of stocks and the earnings of the companies underlying the indices. Although the PE ratio of the S&P 500 is above its long-term average, there is a way to get a read on relative valuations between asset classes. Inverting the PE ratio gives the earnings yield, and this may be compared with the yield on bonds. Since 2002, equities have had a greater earnings yield than bonds, and that is unusual based on history. Sooner or later, bonds will either increase their earnings yield, or equities will reduce theirs by increasing the price level. This situation suggests equities remain the better bet for the long term. In order for the markets to move forward without increasing the PE ratio greatly, equity prices must keep pace with earnings. The forecast for earnings is to increase by about 5 to 7% per year for the remainder of this year and next. Another look at relative valuations suggests that investors in this environment would be wise to shift equity portfolios toward value assets rather than growth. Growth has led throughout this expansion. Value stocks tend to be more defensive also. Higher equity values suggest this is an environment for strong security and sector selection. I favor sectors with lower than average PE ratios. Financials and healthcare are two strong sectors for the long term. Looking at global manufacturing, we can see that there is quite a bit more orange and red on this chart than previous quarters. What's interesting is that the weakest areas are those that depend on exports, likely hurting from the tariff discussion. Take a look at Germany, Taiwan, Mexico, and Russia. The weaker areas of the previous chart are the ones on this chart with exports as a significant share of GDP. At only 8% of GDP, the US is actually somewhat insulated from the situation. Rather than trying to run with the short-term volatility of the markets, investors may be well served to look beyond the current trade talks to the future and invest based on a long-term view. Those hurting the most by the current discussions may be the areas who benefit the most from the eventual resolution. Domestic investors will find greater value overseas. It may take patience, but there is a lot of room for growth outside of our borders. Historically, the US has led for a number of years, and that has been followed by outsized growth overseas. The most recent period has been the longest period of domestic leadership. Eventually, domestic markets should lag overseas markets for a period of years, if historical trends repeat. As of the end of June, the S&P 500 is up about 18.5%. If that were the number for the whole year, it would be a very good year in the markets. One message investors should take from this, though, is that the remainder of this year could be a tougher environment. When markets are low, all it takes is the courage to invest. When markets mature, it's important to rely on experience and knowledge. One of our long-term risks is government debt. Currently, paying interest is about 9% of the federal budget. As more debt is accumulated and interest rates rise, the cost to carry the debt will increase. Although it is manageable now, sooner or later the government must show some financial responsibility. The dangers are considered to be far in the future still, but it is a long-term danger. Notice in the bottom right that federal debts are expected to increase the rate of growth, and that's not a good trend. See the bottom left chart for CBO expectations for the economy. For this year, the Congressional Budget Office expects GDP to grow by almost 3%. Going forward, they see growth rates slowing back to sub-2% levels. It's important to note that this isn't an anticipation of recession, it's simply an expectation for the rate of growth to decrease. The current expansion in the markets is the longest since World War II. It's important for investors to keep perspective at times like this. Expansions don't die of old age. Keep an eye on the fundamentals of the economy rather than just the length of time since the last recession. What should investors do? Well, it takes courage to invest. Even though the market finished positive 75% of the years in the last 39, the average year saw an intra-year decline of almost 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor long-term growth. The dip we saw last year of 20% ended at a loss of only 6%. Those who were hurt the worst were those who panicked and sold for the loss. The markets have felt volatile over the last year, but compared to history, moves have actually been quieter than historical averages. The markets would have to get quite a bit more volatile between now and the end of the year to even have average volatility. We would all love to be able to invest without risk. If I offered someone an investment which had an average annual return of around 7% a year, most people right now would jump at it. That's what the red line represents. What that line really represents, though, is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis, or the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, though, they create more financial opportunity loss in the portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of greater than 50% in the S&P 500 to return to the 7% average line. Last year is just a small blip at the end. It's important to note here, though, that the S&P 500 is an unmanaged index. It's not possible to invest directly in the S&P 500 index. Past performance is no guarantee of future results, but there are some successful money managers who have seen even better results than this. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can help make growth a smoother ride for the investor. There's also another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may also return to the normal situation where managed money beats unmanaged money 2/3 of the time. Also, current strength in the market may make it tempting to park some gains in cash. Although there are periods where cash is king, over the long term, cash is always found near the bottom of returns. Investors with a long-term view should invest in long-term assets. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against a loss. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own returns to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 1.9%, the average investor hasn't kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I am always happy to review and answer questions. The disclosure charts can be a bit of an eye chart here, and hard to absorb in this format. My presentation's on my website. You can review these more closely at your leisure. Thank you for your time. If you have any questions, please feel free to reach out to me. Financial planning isn't done in presentations. It's a personal, collaborative effort considering each particular situation.